Hello and welcome. My name is Jeffrey Kennedy and welcome back to another episode of Elliott Wave Junctures. Today we're going to be looking at volume and how I actually utilize volume in my analysis and forecasting and what tends to be the way many technicians actually view volume. Very simply, or the most simple interpretation of volume, is in an uptrending market when prices are moving up. For example, this portion of the price chart here, this is clearly an uptrending market. What we like to see is we like to see volume expand on up days and contract on down days. Now, if the trend were just the opposite, if the trend were down, then we actually want to see volume expand on these down days and contract on up days. Now, from an Elliott wave perspective, one way that you can actually view that or look at that would be, for example, here's a 5-wave move to the upside. What you would really want to see structure-wise, or the appropriate volume signature, would be volume expand on these impulse moves, these waves 1, 3, and 5, and then you would actually like to see volume contract on these counter trend moves, these waves 2 and 4. That's what we like to see. Okay, now one thing that's very important to understand is when you look at, say, for example, the price chart. Let me pull this price chart back over. This is the Apple price chart, Apple Daily. Now, one of the reasons why volume is viewed as a secondary indicator is if you notice, for example, right here I have red bars. Now, let me slow down for a moment and explain why these bars are red and why these bars are green. Very simply, in the bottom we have volume. On top of that we have a black line. That black line is a 10-period simple moving average. And the reason these bars go from green to red, it simply means that volume is either above a 10-period simple moving average or it's below a 10-period simple moving average. So that's what's coloring these bars green and or red. And what you'll see many times, like for example this formation right here, or this cluster of red bars, that basically means volume is decreasing as the market is moving up. Now, the ideal way to view that would be that's a sign of impending weakness. But what you can see happened is the market actually continued higher. This is exactly why volume is viewed as a secondary indicator and a secondary indicator only. And that's not me saying that. That's actually Charles Dow saying that. Charles Dow actually viewed volume as a secondary indicator. Yes, it was a consideration in his analysis and work, but it was not a primary consideration. Very important to understand that. Now, from an Elliott wave perspective, one thing that we do as Elliotticians, we like to see the appropriate volume signatures at the appropriate time with respect to wave formation. What do I mean by that? Okay, let's play, for example, that this is a 5-wave move, waves 1, 2, 3, 4, and 5. Okay, here's my 1, here's my 2, here's my 3, here's my 4, here's my 5th wave move. Now, the ideal volume signature we would like to see in this instance is we'd like to see volume in wave 3 greater than what was experienced in wave 1. So when wave 5 develops, we actually want to see volume less. We want to see volume decrease as wave 5 develops versus wave 3. So, for example, if volume here in wave 1 was, we'll just say that's a 3, then here in this move here in wave 3, we want to see volume at like an 8 level. And then when we start to develop in wave 5, we want to see volume, say, at a 4 or 5 level. Okay, we want to see volume decrease as wave 5 develops. Now, if volume actually expands as wave 5 is developing in comparison to the volume signature or the volume levels achieved in wave 3, then that is a good indication and a very solid clue that wave 5 is actually going to extend or be an extended wave or an extension. Now, also, too, there's a very specific volume signature with respect to, say, counter-trend moves or corrective waves. For example, we have, this would be, say, an ABC of a zigzag. Well, of course, we want to see volume decrease in wave C of the ABC and be less than what was experienced in the formation of wave A. So keep that in mind. Now, in this instance here, I'd like to just go through a few examples on this price chart of Procter & Gamble and just pull out a few things that I think are interesting here. Like, for example, here we have green price bars. The market's going down, volume is expanding. This is an indication of the trend is down. Now, over here, we actually have prices moving to the upside, but even though prices are moving to the upside, volume is decreasing. Okay, that's kind of a warning sign that there's a bit of weakness. Now, we saw the same condition in Apple, but in Apple, though, it did not yield a pullback. Okay, again, it's specifically what I'm referring to is the example that I pointed out right here. Notice we have red price bars, meaning volume is decreasing, yet what happened? prices actually continued higher and did so. They actually accelerated a bit. Here we have the same signature, and this one led to a move to the downside. Again, this is precisely why volume is a secondary indicator, but the way you can actually handle that, not analytically, but from a trading perspective, is simply be proactive in managing your risk. Raise your protective stops. If you have too large a position, now's a good time to actually scale out. So if you have 100 shares, maybe drop it to 50 shares. Tighten the stop up a bit. Manage risk. Always be managing risk. The one thing I like to say in my writing, there's a motto that many salespeople have, and that's always be closing. Always be closing. If you're a salesperson, always be closing. If you're a trader, always manage risk. Always be managing your risk at all times. That's what you should be doing as a trader. Now, in this instance here, again, going back to this structure here, notice that with the volume decreased on this pullback here, again, that's more suggestive of, hey, we're not going to see much more follow-through or much downside in this market. This turned out to simply be an ABC structure, possibly, well, no, actually, it was a larger structure. I believe that was maybe even an ending diagonal in that market. Let me compress the chart just for a moment and kind of get off. Oh, that looks like a nice little ending diagonal. Break gap here. This would be a breakaway gap. Another gap right here. That's an acceleration gap. One of these days I'll put together, I'll spend with EWJ. I'll talk about price gaps and how they can be useful in your market analysis as well. Now the final, one of the final price charts, again, I would like to take a look at is here. Notice with respect to, say, this advance in this issue. This is silver wheaten, ticker symbol SLW. Notice what's happened. As prices have moved up here, notice there's a clear move or a clear decrease in volume. This is exactly what you want to see. And this is the exact kind of a signature that argues that this is indeed a counter trend move within a larger downtrending market. Now again, as a secondary indicator, what I then want to do is maybe move down to the 60 or 120 minute chart level, determine if this is a 5-wave move or whether or not this is a corrective structure. Also, too, it would be worthwhile to say, take a look at some of my momentum indicators, MACD histogram, stochastics, RSI, rate of change, anything like that. Even CCI, the CCI, the commodity index tool. Okay, now also too, one more thing I would like to leave you with, again, is just the importance of volume. Ideally, and again, this is ideal, this is a perfect world, what we want to see in an uptrending market is volume expand on up days and contract on down days. In a downtrending market, we want to see volume expand on up days and expand on down days and contract on up days. That's what we like to see. Now, with everything that you've learned today about volume, let me just leave you with one more price chart here. This is kind of a bonus chart. This is the U.S. Treasury bond. This is the 30-year Treasury bond. Well, clearly the trend has been up for quite a while. Okay? Well, look at recent price action. It's slow, it's sideways, it's choppy, and it's decreased in volume. Okay? Perhaps what we're seeing here is that this is simply a counter trend move within a still larger uptrending market. If you want to know more about bonds, Bill Fox, dear friend, long-term friend actually, he's the editor of the Specialty Services Interest Rate Product. You may want to take a look at that. Thank you and have a good evening.